we're joined by someone with 3 decades of experience advising in institutional markets. Bill O'Neill is Chief Investment Officer for this region at Merrill Lynch Wealth Management. Thank you so much for coming in, Bill. We are seeing a large correction. Can we call it large? A correction, at least, on these commodities. Does this have to do with fundamentals or just a little bit of risk aversion?
Well, Francine, I think the two key fundamental drivers here are the perception that basically economic growth is slowing. And my sense here is that it's slowing, it's not collapsing. All the lead indicators suggest growth is still going to be quite decent going forward. The other issue is basically how long the Fed will remain easy and accommodative. I don't think that's going to shift. It will remain supportive. So I think the issue here is where cheap money is going. We saw a rehash of this in some respects last December with the emerging market equity markets, when the money suddenly shifted there. The money will go somewhere else. It may not return to commodities in the fashion it was, but it'll continue to follow cheap assets.
But what about, if the US has QE3, yes, we are still going to have that cheap money. Will that go back into commodities? Is it too early to tell?
I think it will return to commodities because they are the proxy for the area of the world that's actually producing growth, which is emerging markets. The interesting story for me is I think for the second half of the year, I think it'll return to emerging market equities. I think that's where the actual
instead of commodities.
Instead of commodities, I think the action will be. And I think on the commodity set, I think the more interesting story, particularly around Chinese demand, is base metals, and particularly copper.
I guess the fundamental question is, was there a bubble in commodities, or is there still a little bit of a bubble in commodities?
Well, it's hard to perceive it because basically you could argue, given the role of financial investors, that possibly there was. Certainly in the precious metal side, you could argue. There was a perception that basically the dollar had been oversold, so that was part of a bubble. We were of the view that basically the oil price would peak this quarter and the dollar would trough. It's come a little sooner than we thought and more savagely, but my sense was that basically the dollar was oversold.
Bill, how much of a significance has the last 24 hours actually been? Because we heard from the first time Jean-Claude Trichet also talking about the dollar. Now, this is the first time I've ever heard ECB president look stateside to see what they're doing in terms of interest rates. How has that all affected your portfolio?
Well, early days yet, of course, but I think the issue in relation to the reference to the dollar was, I think, the fear of a disorderly fall in the dollar and how disruptive that might be for financial markets.
For the euro? Really?
But broadly all markets. And I think that was the risk through this quarter, that the dollar would fall headlong in a disorderly fashion, creating risk premium, generating risk premium, higher risk premium across all markets. My sense here is that it does provide us with opportunities in a pullback, not necessarily immediately in commodities, more still around the emerging market plays.
In equities? Any specific countries that you'd be looking to buy?
It's particularly those countries that stand to benefit from where they've already had an anti-inflationary policy stance in place. China, Malaysia, debatably Brazil. It's also probably the consumer sectors in these markets as well that would benefit if commodity prices come off, as they have, enhancing real incomes, deflecting the need for higher interest rates for longer in these economies. They've already been tightening since the beginning of the year. So I'd be looking at consumer plays in the emerging market set and economies that have already been fairly tough in regard to policy.
Would you stay away from the US and Europe?
Well, we're overweight the US. We're underweight Europe, by the way, Europe ex-UK.
Europe, what, just because of the debt crisis, and the outlook seems a lot more uncertain
here?
But
it's necessarily the sense that basically earnings and momentum in Europe was softer than the US. The underlying valuation story for Europe ex-UK was not as strong as in the US. And I think the US story also fits in with a shift towards large cap themes in the second half of the year, away from small cap.
The US, how concerned are you about what we're going to hear from the jobs report today? And would that possibly make you change your view on equities stateside?
No, I mean, anything that keeps the Fed on side in terms of basically supporting money flow, that's the key issue.
That's going to be positive for you.
That's the issue, and it basically keeps the Bernanke friendly environment, Bernanke's role of friendly environment for financial markets in place. The important thing I think about the jobs report is actually trying to get a sense of how much jobs growth has been foregone because of the effect of rising costs on margins. And there is a give factor here.
But Bill, I guess the problem with the jobs today is that we're starting to realize that the labor market is a lot less flexible than it used to be, and we're looking at structural problems that will continue in years to come. So how does that affect your equities?
Well, we have no idea where the non-accelerating rate of unemployment, inflation rate of unemployment is in the US. It's a very new world in terms of the post-crisis environment. Some say 7, some say 7.5 in terms of. We know there are significant levels of underemployment and unemployment in the US that are not structural.
Yeah.
And the Fed will still focus on dealing with that.
Yeah, and we'll find out more midday for that employment figure. Bill O'Neill, thank you so much for joining us today.